The most dangerous trade you'll ever make doesn't feel reckless. It feels responsible. It feels disciplined. It feels like exactly the kind of cool-headed decision a serious trader would make. You're not panic buying. You're not chasing. You're calmly adding to a position that's down, lowering your average price, getting a better deal on something you already believed in. It feels like patience. It feels like conviction. And that's exactly why it's so deadly. The trade that wipes out accounts almost never looks like a gamble. It looks like a strategy. Today I want to show you how averaging down quietly turns a small mistake into a catastrophe and why it feels smart the entire way down. Let's start with what averaging down actually is. You buy something. It drops. So you buy more at the lower price. Now your average cost is lower, which means the price doesn't have to recover as far for you to break even. On paper, this sounds brilliant. If you liked it at 100, you should love it at 80, right? That's the logic every losing trader uses to justify the decision that eventually breaks them. Here's the problem. That logic is borrowed from investing, not trading. A long-term investor buying a diversified index for 30 years can absolutely benefit from buying dips. But a trader holding a single position with a thesis and a time horizon is playing a completely different game. And the moment you average down on a trade that's moving against you, something subtle happens. You stop trading the market. You start trading your own ego. Think about why you really add to a loser. Not the story you tell yourself, the actual reason. The price went against you. That means the market is telling you that your original idea, at least for now, is wrong. Adding more isn't a response to new information. It's a refusal to accept that information. You're not saying the trade got better. You're saying you can't be wrong, so the market must be. This is where averaging down reveals its true nature. It's not a strategy. It's an emotional escape hatch dressed up in the language of strategy. Being wrong feels terrible. Realizing a loss makes it permanent and undeniable. But adding to the position lets you postpone that feeling. As long as you haven't sold, the loss isn't real yet. You can still tell yourself the recovery is coming. Psychologists call this loss aversion. The pain of losing is roughly twice as powerful as the pleasure of an equal gain. So we'll do almost anything to avoid locking in a loss, including throwing good money after bad. Averaging down is the perfect crime against yourself, because it disguises avoidance as action. You feel like you're doing something proactive. In reality, you're just buying emotional relief with real capital. Now let's talk about the math, because this is where it stops being psychology and starts being arithmetic that doesn't care about your feelings. When a position drops, the percentage you need to recover grows faster than the percentage you lost. Lose 20%, you need 25% to get back. Lose 50%, you need 100%. Lose 80%, you need a 400% gain just to break even. Averaging down feels like it shrinks that gap. And it does, but only by increasing the size of your bet on the very thing that's already losing. You've lowered your average price by raising your total risk. Picture it. You risk a small slice of your account on a trade. It drops, so you double the position. It drops again, so you add more. What started as a controlled 1 or 2% risk is now 10, 15, 20% of everything you have concentrated in your single worst performing idea. Read that again. Your largest position is now your worst position. That's the exact opposite of how risk is supposed to work. You've built a portfolio that rewards being wrong with more exposure. And here's the cruelest part. Averaging down works just often enough to be dangerous. Most of the time, the price does bounce a little. You break even, maybe make a small profit, and you feel like a genius. The market rewarded your patience. So you do it again. And again. Each small win reinforces the habit, training you to add to losers as your default response. You're building a strategy that pays you in small wins and bills you in one catastrophic loss. Because eventually the trade that doesn't bounce shows up. The one with bad news behind it, or a broken trend, or a thesis that was simply wrong. And on that one trade, your oversized, average down position takes a bite out of your account that 10 small wins can't repay. This is why averaging down quietly bankrupts traders. It's not loud. It doesn't blow up in a single dramatic moment of recklessness. It erodes you through 100 responsible feeling decisions, until one of them is fatal. So how do you tell the difference between a real planned entry and an emotional rescue? The answer is brutally simple. Timing and intention. A planned scale-in is decided before you enter, when you're calm and have no money on the line. You know in advance exactly where you'll add, how much, and where you're wrong. The adds are part of the original blueprint. Averaging down is decided after the pain starts, in reaction to a loss, to make a bad feeling go away. If you only thought of buying more because the price dropped and it hurt, that's not analysis. That's anesthesia. Here's the question that cuts through every excuse. If you had no position right now, would you open this trade fresh, at this price, in this size? If the honest answer is no, then adding isn't conviction. It's denial wearing a suit. The professional move is the one that feels worst. Accepting the loss. Taking the small, clean hit while it's still small and clean. Admitting the market knew something you didn't, and living to trade tomorrow with your capital intact. Great traders aren't great because they're right more often. They're great because their losses stay small and their winners are allowed to run. Averaging down does the precise opposite. It nurtures losers and starves your account. So the next time you feel that calm, responsible urge to lower your cost basis on a trade that's bleeding, pause. Ask yourself if you're managing risk, or just refusing to admit you were wrong. Because the most dangerous trade you'll ever make won't feel reckless at all. It'll feel like the smart thing to do.